So today we're going to talk about a stock that is down 73% from its all-time highs, and I'm going to talk about why potentially I'm watching this stock and potentially I could come and buy it in the next few months. And I thought, you know what, I was talking about the other day on a video about stocks that I do a lot of research in, and sometimes if I'm not a buyer, I never actually post the research that I've done into them on the channel. And I thought, you know what, today I've done quite a bit of research into it and I'm not a buyer at the moment, but I thought I'd just share it with you as a stock that I'm interested in. It's on my watch list, and potentially give it a few months, it could be a stock that I would not mind owning. So hopefully this research I have done and I'm going to share with you is useful, and I'd love to hear your comments about it or thoughts in the comment box below, and see if you guys think this is potentially an opportunity. It is a growth stock on the UK market, and we don't really have too many UK growth stocks like this, so I think it's quite a unique opportunity. Now, first of all, I just want to apologise, there was no video on Friday, and that's why I'm doing it today on the Saturday. The reason why is I just got a bit too busy on the Friday evening to sit down, do the research, put the video together, so I thought, okay, we'll just do it on the Saturday. And the other reason why is the time that I did have free, I did put it together to make this video, which was on the Patreon, which is the stock request. This is where members on the Discord can vote for 3 stocks they'd like me to take a look at and give my thoughts on them. One of them being Forterra, the other one being Block, and the last one being Legal in General. It's about a 20-minute long video, so if you do want to see that exclusive content on Patreon, join through the link in the description. We post 2 exclusive videos a week on there, and I also post my live buy and sell alerts as well. And it's only £5 a month, which I think for the content that I do try and put on there is definitely worth the £5. And also there's a Discord with 600 members to talk to as well, so if you want to join that, link is in the description. But let's get stuck onto this stock. So like I said, it's a UK growth company, and it's a company called Darktrace. So this stock actually IPO'd in 2021, and basically since its IPO it is down around 24%, so it's down a little bit since its IPO, and obviously that's nearly coming up to 2 years after its IPO. But during its IPO it actually ran all the way up to nearly £10. Absolutely bonkers, the share price run that it went on after its IPO. Now obviously automatically we're thinking 2021, it was a bit of a year where growth stocks and valuations did go a little bit crazy, and since it did hit that all-time high, now that it's down 73%, it's quite interesting. Since its IPO, 2 years progress and it's basically down, so it comes quite an interesting opportunity. So Darktrace, obviously UK growth stock, it's a 1.7 billion market cap company. It does have a P ratio, and it's one of those P ratios that stands out in like 1,400. It's overvalued. The reason why it looks extremely high on a P ratio is that this year they just made it to profitability. So because it has only just crossed the line of profitability, that's why the P ratio looks extremely high. So the P ratio is not a good metric to use on this one. Now Darktrace is in the cyber security space. Now this is a space that I have been very eager to get into. It's one of those spaces that in the next 10 years I believe is going to be a massive space, and I think it makes sense to have a player in this area. The only thing that's ever kind of put me off getting a player in this area is the valuations on many companies in this space. They are expensive. But with this one here and having a bit of a beating down, is it now an opportunity where I could potentially add a cybersecurity stock into my portfolio? Now, like I said, the cybersecurity space is growing massive, and if anything, the last few years have proven that with the cyber attacks that have been going on, cybersecurity is going to be more and more needed. And you can see at the moment, at the current rate of growth, damage from cybersecurities will amount to about 10.5 trillion annually by 2025. A 300% increase from 2015 levels. And also, organizations around the world spent around 150 billion in 2021 on cybersecurity, growing by 12.4% annually. So this is a fast growing space where, if anything, the threat of cybersecurity attacks are just going to increase, and people are going to look at cybersecurity companies like Darktrace, and that's why you'll see very established companies use Darktrace as one of their cybersecurity platforms. An example of that would be the NHS, who has a major contract with Darktrace, and there's many companies out there as well that are using them. Now Darktrace actually comes off a really good financial year 2022. Their RR growth was 42.6%, adjusted EBITDA margin of 22%. They launched a new platform which was Prevent, and they also had year-over-year revenue growth of 45%, which is really good. Now when you look into their platform, these are the 4 products that they offer. There's the Prevent, which is the new one, and they use a lot of AI, and they also use a lot of AI learning, so the platform is always learning to improve and make sure for future attacks it's better to deal with any future situations. Obviously, Prevent is to identify weaknesses inside the business to stop security attacks happening. detect to see any attacks that are happening on the platform at the moment, respond where if they have been or a company is attacked by a cybersecurity attack, that it deals with that situation, and heal where if it has had a cybersecurity attack, it recovers, and any situations that have been caused by a security attack, they resolve them issues. So you can see here 4 products that businesses will look to use. They potentially could use one of these products, or they could tie into all 4 of them. Now, when you look at the business from a longer term point of view, you can see here the revenue has been increasing really well since financial year 2019 and improved massively over the last few years. Most of the revenue from this business is reoccurring or subscription revenue, which is probably what you want to have in this sort of business. And you can see here that's over 99%, which is obviously great. And you can also see the significant contracted backlog that Darktrace currently have. Now, what I really like about this is the amount of money that customers are now spending with Darktrace. You can see here that not many companies were spending over 100k. You can see here now it is over 1,235, so that's massively increased. And the great thing is when you look at the platform adoption, what you have in here is when you're a company that maybe offers one product, the risky thing is that if you only offer one product and then say someone else offers another product that potentially could be better, you leave that one product and you go to this other product and you lose their service. Now, what Darktrace at the moment is doing, because they've launched all these products, is a lot of companies are getting tied into using all of the products. So if you look at financial year 2019, for example, there wasn't that many companies, say, using 4 products in the ecosystem of Darktrace. That went up to 24%, up to 39%, and now 46%. So 46% of the clients that Darktrace currently have are using all 4 of the products that Darktrace currently have, which is fantastic because, like I said, one product, very easy to move away, the churn could be very high. But if you're tied in that Darktrace ecosystem and you're using all the products, it's very hard to move away from 4 products and leave the customer or not be a customer anymore in Darktrace. So that's a really good sign that people are using platforms in Darktrace and then ended up using more and more, which is great. So hopefully Darktrace can continue to improve these platforms they offer and potentially expand with a 5th one in a few years. We'll see what happens. And if we have a look at the recent earnings, you'll be able to see the growth in revenue was 45% year over year. You'll be able to see the cost of sales is extremely low in this business. You can see here that if they're making 415 million, the cost of sales is 44 million, so the gross profit is 370 million. That's correct, that's nearly 90% gross margins. So if they're making 9% gross margins, why is the PE so high on this business? Well, the big thing is there's sales and marketing costs, but there's also a lot of research and development costs improving the platform as well. So that is currently eating up a little bit of the gross profit at the moment. Now, the great thing is they have got to a point now where they are at break even, so they are able to reinvest and grow the revenue and take a market share in this space, and also protect the balance sheet a little bit at the moment. Now, obviously, some financial costs from the last year would have been because of the IPO in 2021, but the moment you look here, it's got good revenue growth, good gross margins. They aren't burning through the balance sheet, they're round about a break even, and they're reinvesting into the business. So I'm quite happy where this is from this financial point of view. The only problem is that when you do look at the business, it is quite hard to work out from a profit point of view because they are really heavily invested into the business. And that's the problem that a lot of people have with growth stocks, is that when you don't have profit, it's quite hard to value it. Darktrace is the same because they are reinvesting a lot of that profit into it. You're kind of guessing what the profit could potentially be further down the line. So taking all that into consideration, you look at Darktrace and you think, okay, this company's made really good progress in the last 2 years since its IPO. So why is the stock down 24%? Surely the stock should have, maybe it went a little bit crazy from a valuation point of view in 2021. But when you look at 2023 and we're 2 years on from the IPO, why has the company not really made that much progress? Because when you look at financially, you'd be thinking it has done quite well. So my feeling why Darktrace has potentially underperformed on a share price point of view is, first of all, IPOs do tend to be a little bit overvalued. So potentially that played a little bit of a part, not as much now because the company has grown so much. I also think that potentially we have been in the bear market and growth stocks have been really compressed. So without doubt, that has been one of the issues inside the business as well. Another point that I currently have, I think, with Darktrace is that I have up to 2020 here. I can't find the newest information, but you'll be able to see the UK growth here. But you'll see the US and Canada has come a major part of the business. In fact, the number one place of revenue for Darktrace. And I do feel like Darktrace has been misvalued by the UK markets. We don't tend to get many growth stocks in the UK market, and a lot of companies now do tend to, or UK companies do tend to avoid the UK market because we don't seem to value growth stocks correctly. And I think there has been a bit of unfair undervaluation from the UK markets, and this is why so many of them avoid the UK market. Now, I know that originally when Darktrace was looking to IPO, they actually had a meeting at the time with the Prime Minister, Boris Johnson, who really wanted to get them a company like Darktrace not avoiding the UK market and moving to the US. Unfortunately, I think Darktrace made a bit of an error here. I feel like if Darktrace did potentially IPO'd in the US market, they might have been valued a little bit higher than where they are right now. And unfortunately, that is a little bit of the situation of value in the UK, but that potentially gives us an opportunity. An example of that, for example, would be Darktrace is currently valued at 5.4 times sales. If we look at something like a CrowdStrike, for example, which once again is a cybersecurity company as well, and they do grow a little bit faster than Darktrace, however they lose money compared to where Darktrace is profitable, so that kind of balances things out. For example, even after the stock crash in CrowdStrike, the company still trades at 11 times sales, which is over double what Darktrace does. So it kind of shows you an example there where you could argue that Darktrace is a little bit disrespected on evaluation. But we've seen it for a company that I talk about. You know, I do really like growth stocks, and in the UK portfolio, I only really own one growth stock at the moment. Well, technically two. I recently did buy a new one, which I haven't talked about on the YouTube channel yet. That's a bit of a top secret one. But I only own one UK growth stock, which is S4 Capital. And S4 Capital is a bit similar to Darktrace. It's a very good, high quality UK growth company. However, once again, growth companies in the UK don't seem to get valued that well. S4 Capital has been, and I stand by this, the best UK growth stock out there. And what have we seen in the last few months? It's got totally misvalued. And recently it has been having a really good share price run, which was, without doubt, it was going to happen at some point. But it shouldn't have got this low. And you're talking about a company like S4 Capital that is very much near a break-even point of view and growing 25% year over year. And you had a company like S4 Capital trading at 1.5 times sales, which just doesn't make sense. Now, obviously, Darktrace is a little bit higher on a price to sales ratio than S4 Capital, and that's why I think probably S4 Capital is still a better opportunity than Darktrace. But we are seeing these companies getting valued extremely low on the UK market, and I think that is an issue that Darktrace potentially should have been listed on the US. So maybe that's something they look to do in a little bit, and I think S4 Capital is something like the same. But at the moment, it potentially could create an opportunity for us UK investors to pick up a high UK quality growth stock at the moment on sale. The other reason why Darktrace has come under pressure on a share price point of view is Mike Lynch. So Mike Lynch is currently an IPO investor, or one of the first backers through its VC fund. And because he is a big shareholder in Darktrace, and he has come under some heat at the moment because he has been investigated for accounting fraud, because he was, I think he was the owner or shareholder in Autonomy that sold it to HP for 11.1 billion, and then HP went to write down the value of it to 8.8 billion. And then they've been pursuing Lynch through the courts, and then also the former CFO of Darktrace as well. He has also been tied up in this as well. So there's some former CFO issues and some shareholder issues with Mike Lynch, who have been tied up into this, and because they have relations to Darktrace, that seems to affect it. Although since that time, the CFO has obviously left, and also Mike Lynch is just the shareholder of Darktrace. So obviously there's the concerns around there. I don't think it'll turn into anything, but that's probably obviously caused some issues that people are getting worried that they are slightly related to the company Darktrace. Probably the other issue that maybe pushed the share price down a little bit, but this is only recent, is they came out with a trading update in the 11th of January. On the 11th of January, they said that they're doing quite well. The only issue was the outlook. They said that they've seen new customers slow down at the moment, and then they did downgrade the guidance, which is now to expect 29.5% to 31%, and previously that was 30% to 33%. So it's not a major change, but it was a little bit of downgrade of the guidance. And obviously when you're a growth stock and the main thing you focus on is growth, and you come and downgrade your guidance, obviously that's going to see you take a little bit of a beating on the share price, and that did start to happen on Darktrace, and it's took about a 14-15% hit since that. But overall, I think the growth is still good, and obviously the reason why the slowdown in new customers has happened with Darktrace is because of the economic environment that we're in. You're seeing a lot of companies tighten up the budget a little bit and say, oh, okay, it might be a little bit of a bumpy kind of few months. We'll see how we do, and then maybe we'll look at our budget for something like cybersecurity. So without doubt, that's what's affecting the company at the moment, and that's what affected the guidance. So if we do see the economic environment deteriorate a little bit more, then I potentially could see this happen a little bit more. Obviously, and what the stock market is kind of thinking at the moment with the recent rally is that if it isn't that bad of an economic environment, then potentially we see this as just a once-off, and we see companies come back to spending on cyber defense security a little bit more going forward. So this is definitely something to I would keep an eye on, and it's one thing why I've held off at the moment, is that I want to give it another 3 months for another trading update and see, okay, companies are a little bit more confident and spending again, or do we get a double whammy of a profit warning or a revenue warning, and then potentially we see, you know, the share price take once again a little bit of a leg down. So that's one of the things that I'm personally waiting for with this business. Now, like I said, it does trade at 5.4 price to sales ratio. But actually, if you give that a little bit longer into June time, when they actually post their full accounts, we'll actually have a price to sales ratio down at a 3. So give it a couple of months, this valuation, this price sales ratio drops a little bit more, which would actually be really good to see. And this company does throw off a lot of free cash flow. At the moment, you'll be able to see at the moment, last year they did 107 million in free cash flow, which is obviously near 17 times free cash flow, which does look not too bad at all for a company growing at 30%. Obviously that free cash flow is going to drop slightly down to 65 million, but actually in 2024 then it will cover back to 109 million. So yeah, I mean, you're around about 17 times free cash flow, which isn't bad at all for a company at this sort of rate if you use your free cash flow. Obviously at the moment they're at a break-even point of view on profit because they're reinvesting into the business. And the ultimate really tough question with this one, and what everyone's trying to work out, is what potential profit can they throw off in the future. Obviously that's what everyone's trying to work out, potentially what it could be. I would say that when you're a company that has 90% gross margins, I think you do have a good chance of making good amounts of profit in the future. As you can see here, Simply Wall Street thinks it's 53% undervalued when they run their numbers. And when you have a look at their numbers, they're expecting the free cash flow to go from 109 million in 2024 to around about 2026, 231 million in 2026, and by 2028 could potentially be throwing off 328 million, which actually doesn't seem too bad actually. You would actually see that's quite achievable when you look at what they're doing right now and you factor in the growth and what they'll be doing in that time frame. Financial health wise, it's really solid as well. There's no debt on the balance sheet, and we don't need to worry about cash burn because they're roughly about break even. They're sitting on 400 million in cash, which for a 1.8 billion market cap company that's very heavy in cash as well. So that's obviously fantastic. One of the little things that are a bit 50-50, the insiders are a little bit choppy. So there's some buying, there's some selling. I would expect that a little bit because what do you have? You have the IPO. Obviously, when you have an IPO, you're tied up for a while until you can sell your shares. So a lot of these investors probably wouldn't have been able to sell the shares, well into 2022. So there's that little factor in that there's probably going to be some lockup period where investors will sell once they have the IPO. So it's a little bit choppy from that point of view. But the most recent buy was on the 20th of January. So about a week ago, and the co-founder and the CTO, he did buy some shares. Now, he did sell some shares on the 11th of November. However, he actually sold them out at £3.96, and then he bought his new chunk at £2.44. So potentially that's a little bit, you would say that's actually a pretty good move. He did sell some shares off at quite a higher price than where the business is right now, and now he's bought them in quite a bit cheaper. So clearly that's probably a really positive sign more than anything, even if it was a sell and a buy. So overall, my thoughts with Darktrace is that it's a company that I'm really interested in. I want to have a cybersecurity business in my portfolio, and I do like a growth stock. And ultimately, it comes down to two things for me. First of all, obviously we had the profit warning or the revenue warning. I'd like to give it another 3 months just to make sure that issue does not continue throughout the year and hasn't got worse. So that gives me at least another 3 months potentially before I pull the trigger. The second thing is the valuation. Now, like I said, I don't think it's terrible when you look at some other cybersecurity companies. However, we have seen UK stocks get to ridiculous valuations. Look at the likes of S4 Capital, for example. So I potentially could see it get a little bit cheaper. Ideally, if I give it until around about June time when it posts its full account, and then that drops that price to sales ratio down to about a 3. I actually think picking up Darktrace for around 3 times price to sales ratio, and potentially it stays at the share price and it gets back to a point of view where it's throwing off around about 100 million in free cash flow. That will put it, around about 18, 17 3 times cash flow for a business at 3 times sales for a company like Darktrace. That would actually come really interesting for me. So that's where I come a buyer. So it's more of a sit, add to a watch list, and I'm going to come back to this one in 3-4 months time. And once I get a bit more information on how the financials are doing and that valuation stays flat for a little bit longer, and I'm getting it potentially at a cheaper valuation, that's where I'll actually potentially come a buyer. So yeah, this is very high on my watch list. I just need to give it a little bit longer. So that's my thoughts on this one anyway, guys. Hope you enjoyed the video. Let me know your thoughts in the comment section as always, guys. Hopefully it was a bit of a long video, but hopefully you enjoyed it, and have a great weekend, and I'll see you on Monday.